By the time most people woke up, it was already under $1. The red candle didn't just break support. It erased months of psychological comfort. $1 wasn't just a price level. It was a belief system, and when it cracked, something else cracked with it. I was staring at the order books before sunrise. Liquidity was thin, too thin. The bids weren't stepping up, they were pulling away, quietly, strategically, almost like they were waiting for something. Then came the cascade. Stop losses triggered, retail panic posts exploded, financial media framed it as risk-off sentiment. But what they didn't say, what I noticed, was who wasn't selling. Because while the public charts were bleeding, on-chain activity told a different story. Large wallets weren't exiting. They were repositioning, slowly, methodically, almost like they knew this flush was necessary. And that's when it hit me. This wasn't chaos, it was preparation. The kind of preparation you only see before a structural shift in control. Everyone's asking, is this the end? But the better question is, why does this drop feel engineered? And more importantly, why does it feel like someone wanted it below $1? Let me show you what I found. When XRP lost $1, the market didn't just react, it unraveled. I've watched crypto long enough to know that round numbers aren't technical levels, they're emotional anchors. $1 represented safety, stability, validation for long-term holders who survived the regulatory storm with the U.S. Securities and Exchange Commission. When that level broke, social feeds turned frantic. 5 years of waiting. Should I just sell? Is this dead money? But here's what stood out to me. The volume spike wasn't explosive. It was controlled, heavy, but not chaotic. That tells me something important. This wasn't blind panic alone. It was assisted momentum. Markets don't collapse in silence. They collapse when liquidity disappears. And in those early hours, I noticed bids stepping away before the sell pressure even accelerated. Someone anticipated the drop. And when anticipation meets thin liquidity, gravity does the rest. But the real question forming in my mind wasn't about retail fear. It was about positioning. Because breakdowns like this often precede narrative shifts. And narrative shifts are where money changes hands. While everyone was watching the 5-minute chart bleed red, I shifted to on-chain flows. Large wallets, the kind that don't move impulsively, began accumulating in structured increments just below $1. Not aggressively, not recklessly. Disciplined entries. I've learned to watch behavior, not headlines, and behavior was calm, no mass exchange outflows, no panic transfers, no dramatic distribution spikes. Instead, I saw consolidation. When whales panic, they move size fast. When they position, they move size quietly. And this was quiet. It reminded me of previous accumulation zones, long stretches of boredom before narrative ignition. Retail tends to sell into fear. Smart money tends to buy discomfort. But here's what made this different. The buys were happening in layers, almost like someone expected volatility to persist before stabilization. That tells me one thing. They're not chasing a bounce. They're preparing for something larger. You can't discuss XRP without acknowledging the regulatory overhang. The shadow of the U.S. Securities and Exchange Commission has shaped price action for years. Even when clarity improved, hesitation lingered. Markets hate uncertainty more than bad news. Right now, broader crypto sentiment is cautious. ETF delays, legislative gridlock, macro pressure, risk appetite thinning. But here's what I've noticed over time. Regulatory fear creates discounted entry points. Institutions don't wait for perfect clarity, they wait for asymmetry. Below $1, risk-reward dynamics shift. Downside becomes defined, upside becomes narrative-driven. If legislative movement accelerates later this year, positioning at sub-$1 levels will look strategic in hindsight. And that possibility is exactly why I'm not reacting emotionally. Because fear peaks before clarity arrives, and clarity tends to reprice assets quickly. I kept coming back to one thing: liquidity. Order books felt hollow. When liquidity dries up, price doesn't move logically, it moves violently. That's what we saw. But liquidity vacuums don't happen randomly. Large players pull bids before volatility events. They let price fall into empty pockets, then they reintroduce capital at better levels. I've seen this structure before. The market flushes weak hands, sentiment collapses, media reinforces negativity, then silently bids reappear. Below $1, I began to see subtle rebuilding in the books, not obvious enough for headlines, but present. That's not retail behavior, that's patient capital. And patient capital doesn't position for short-term noise, it positions for narrative reversal. What fascinates me most isn't price, it's reaction. When XRP was above 150, conviction was loud, social feeds were confident, targets were ambitious. Now below $1, doubt dominates, same asset, different emotion. Retail psychology is cyclical, optimism at highs, fear at lows, but smart money operates inversely. I'm not immune to fear, I feel it too. Watching red candles stack at 3 a.m. tests conviction, but I've learned something painful over the years. Emotional selling rarely aligns with strategic positioning. If you believed above 150, what fundamentally changed below $1? That's the question I ask myself, and the answer shapes my actions. Here's where I stand. I'm not panic selling. I'm not over leveraging. I'm building structured exposure. If volatility continues below $1, I scale in gradually. No hero entries, no emotional buys, just layered positioning. Because if this move is engineered, yet if liquidity was intentionally pulled, then reactionary selling is exactly what benefits stronger hands. I'm preparing for extended consolidation, not immediate recovery. That mindset changes everything. Every major move begins with disbelief, not excitement, not headlines, not confirmation. Disbelief. Right now, disbelief is everywhere. You can feel it in the silence between tweets. You can see it in the hesitation inside the order books. You can hear it in the tone of longtime holders who used to speak with conviction and now speak with caution. This is the emotional reset phase. When price eventually stabilizes, whether that takes weeks or months, something subtle will happen before most people notice it. Volatility will compress, the violent red candles will shrink, the panic posts will slow down, and the same analysts who are now cautious will begin using different language: constructive structure, higher low formation, accumulation range. Headlines will pivot. They always do. Financial media doesn't predict narrative shifts, it follows them. Once the bleeding stops, articles will quietly shift from risk asset under pressure to digital asset showing resilience. Analysts will revise targets upward, models will be recalibrated, influencers who were skeptical will rediscover confidence. And here's the part that fascinates me most. The same investors who are panicking today will look back and say, it was obvious, the signs were there, but the signs are always there. They're just uncomfortable to act on. Markets reward positioning before clarity, before the ETF approval, before the regulatory headline, before the institutional confirmation, before the breakout candle that makes everyone feel safe again. Clarity is expensive, certainty carries a premium. By the time confidence returns, price has already adjusted. That's the paradox of investing. You don't get paid for feeling comfortable. You get paid for enduring disbelief long enough to recognize when silence is actually accumulation and when fear is simply the cost of entry. Here's my warning. Below $1 is not just a price zone. It's a psychological battlefield. It's where patience is tested, where conviction is interrogated, where narratives fracture and self-doubt creeps in at 2 a.m. while the chart glows red in a dark room. If this drop was engineered to flush weak conviction, then selling into fear completes the cycle exactly as designed. Markets don't just move on supply and demand, they move on behavior, they move on emotional thresholds. And $1 wasn't just support, it was a line tied to pride, to patience, to years of waiting. When that line breaks, control shifts. I'm not predicting immediate upside. I'm not pretending a reversal candle solves everything. What I'm recognizing is asymmetry. When sentiment collapses faster than fundamentals, opportunity begins to form in the gap. Asymmetric opportunity doesn't feel good. It feels isolating. It feels uncertain. It feels like standing alone while everyone else runs for the exit. The biggest mistake investors make isn't buying volatility, it's misunderstanding it. Volatility is not always a signal of failure. Sometimes it's a mechanism, a transfer event, a redistribution of ownership from emotional hands to strategic ones. Liquidity doesn't just disappear, it relocates. And sometimes the scariest levels are the ones designed to transfer control from those reacting to those preparing. That's the difference. I'm not here to win the next 24 hours. I'm here to control my position in the next structural shift. And I refuse to hand that control over cheaply just because the battlefield feels uncomfortable today.